3, 2, 1. Welcome to the show.
All right, welcome to the show. Summertime. Things are slowing down.
Here.
Yeah, it's good. It's good. Things are getting kind of crazy on the market, I guess. But it's going to be an interesting summer. I mean, there's no end in sight you call it volatility or, whatever, but
What is happening is not stopping.
no.
Not anytime soon.
No, not anytime soon. No. Towards the end of the summer, I mean, I don't really think we'll put in a significant top or a significant bottom until the end of the summer. I mean, September, October is always a crazy month. Historically, it's the most volatile when there's going to be huge price swings in a year. It's usually in October. I'm cautiously optimistic, let's say. I'm not even going to say hopeful, but cautiously optimistic, given the 2-year decennial cycle. Usually the fourth quarter in every 2 years in the 10-year turns up. That's
Usually.
like the last thing I'm hanging my hat on, because there isn't anything good down the line other than the fact that historically the year 2 in a 10-year is positive.
Outside of that,
I'm grasping at straws to try to
chaos.
find some reason that's going to go up. So.
Let's jump into it.
All right. So this week we're going to do real quick. We can talk about the TSP tech refresh. It's pretty much gone exactly as we expected. It's a bit of a
Goat rope.
Yeah, that's a nicer way than I was going to put it. Goat rope. And then we're going to do, seeing as how there are some people that have been able to get into the mutual fund window, we're going to do a quick kind of mutual funds 101. Right. What are they exactly? How are they different from ETFs? Give you guys some things to think about whether or not you want to be in the mutual fund window. Bonus chart is going to be a chart of the Nasdaq, which is the tech index from 1999 to present. We did that chart in the monthly webinar that we did for the public Facebook group this week. It was one of the charts that was in there.
Yeah, if you're in our public Facebook group, you'll see up at the top we have an ongoing webinar series. You can register once and put you in it every month. We just did the one for June yesterday.
Yes.
Yeah. And the replay video went out if you're registered. If you register ongoing, you'll get the old ones because they're all in the same bucket. So you get to see the backwards too. So, yeah, check it out.
Yep, it was good. So yesterday's was about how to make a plan for this bear market. So you definitely want to take a look at it.
Mucho bueno.
So if you weren't able to watch it live and you didn't sign up for it, is there a way to get it?
Yeah, when you register now and the next replay comes out,
got it.
All of them are in there.
They're
in a little showcase, so you can go back and see the old ones if you missed it, but you got to register.
You got to register, and you got to wait for the next one, and then you got to wait for the email. Yeah, so get on the list, register, and get on there.
Yeah,
and
you get to see all of them.
To them. Yeah. All right. Okay, so before we get into it, got a little words of wisdom from Alf Pecatello. I found him on YouTube. Really interesting guy. He's from the Netherlands. He used to run a $20 billion investment portfolio, and now he writes at the Macro Compass, which is his site. It's a free newsletter, provides financial education, unique macroeconomic insights, and actionable investment ideas. His stuff is really good, so I would definitely recommend you guys check him out. And he's referring here back to Benjamin Graham. So everybody knows who Warren Buffett is. Benjamin Graham is Warren Buffett's mentor. He wrote The Intelligent Investor, which is probably the single biggest investor Bible there is, I would say. Everybody refers back to The Intelligent Investor. So Benjamin Graham says, before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. I don't know how many times we talk about that exact thing on the show and in the newsletters and everywhere else, right? The idea is not to know what's going to happen. It's to be able to see probabilities. right? It's not about knowing.
Probabilities, not possibilities.
Right. Anything's possible. Right. It's possible the market bottoms in September, and
not everything is probable.
Not probable.
Yeah.
Right. So yeah, and be able to make that distinction between what is a possibility and what is a probability. Right. And then once you whittle down your probabilities, how you react to the consequences of being wrong. Right. We're responding to the market. We're not trying to anticipate the market. We're not timing. We're identifying probabilities and then having a plan to react if we're wrong. All right. So in this, I think it was an email I cut this out of, Alf is saying, investing is all about probabilities. All you need to do is assess the chances markets are assigning to different scenarios today and anticipate how this probability distribution will move over time. He talks kind of cryptically, but in other words, you don't need to necessarily be right on what happens next. You just need to be able to grasp how market consensus will move going forward. So you don't have to be, that's another way of saying you want to be on the right side of the trend, right? When we reallocate today, if the market goes down tomorrow, right, it's not a problem for me because the reason I reallocated is because I've identified a new, let's say, uptrend, right? So if the market goes up 1% today and I get in, it's a green day, right? I'm getting in on a green day, that's fine. If it rolls over tomorrow and we lose a little bit, I'm okay with that because the reason I got in is because I identified a longer uptrend. I'm not worried about the little day-to-day moves. If I'm wrong and the market rolls over and the trend changes, then that's different. Then I'm back out. But the point is, you don't necessarily have to be right about what happens next. Just be able to grasp how the market consensus will move going forward, which is the trend. All right. So let's just talk a little bit about this disaster. So this is a June 7th article that came out in Government Exec magazine. It's online, but TSP participants bemoan bumpy record keeper transition. I thought that was kind of I didn't know if they were trying to place the blame on Alight, which is actually an HR company. They're not a financial institution. So I guess they are doing record keeping, so to speak. But there are a lot of problems, right? Federal employees and retirees have reported problems with setting up new accounts for online access to the to the TSP. And the agency's call center has been deluged. I mean, I'm okay with all that. It's just that they knew they had 6.5 million people that had to create new usernames and passwords. Mm-hmm. And I mean, I'm in tier 2 help desk hell right now.
Tech support tier 2.
I'm waiting for a callback, and if I don't get it by the end of the week, I'm going to call them back. But I have no.
I got money that you're not getting called back.
Yeah, you're probably right.
I'm betting you a sip of tequila.
I mean,
don't ban us, Facebook. I didn't mean to say that.
Yeah, that's right. Right. He didn't mean tequila. He meant.
Yeah. Yeah. You know what's interesting though? I was reading quotes from. I forgot whether it's the head of the board or someone. Right. I feel like sometimes they
Kim
choose.
Weaver.
It wasn't the head of the board then. It was. I feel like they choose random people. Right.
Yeah.
And so this sucker had to. Like give us some explanations. And it was I'm pretty sure it was in Fed Weekly or whatever. And it was like, but we're still processing loans and we're still doing not acknowledging the fact that we can't move our money,
right?
Which they don't want us to. At the end of the day, they don't really care about all of us active managers. What they want you to do is put your money in the L fund and leave it alone.
Yep.
Take out a loan every once in a while.
Yep.
Right? Just max out your TSP because that's their win scenario. Because there's less transactions.
Yep. Yeah, true.
All of this. And I know I'm being pessimistic, and I'm not normally a pessimistic person, but I was in the government for 30 years. So.
Yeah. I mean, I draw a huge distinction between this goat rope, which is a tech refresh, right? Yeah. We've done plenty of them. And that's its own IT-related thing. And then there's what they actually do.
But I feel like they knew that was going to happen. That's what I'm getting at. I feel like they're like, it's going to happen. But you know what? It'll be okay. It'll take us a few weeks to fix it. And honestly, like the people that are kind of writing about that narrative are making it seem like it's okay.
Yeah.
It's not that big. Like, why do you need access like right now?
Yeah.
Are you getting ready to do a loan? Well, we can do that for you.
Yeah.
They're not really worried about whether you can get in the mutual fund window and start trading.
Yeah. No, they're not for sure. I read
Yeah.
somewhere they think there's going to be 2 or 3%.
Exactly.
And I don't think it's going to be that high.
Right. That's optimistic.
I mean, I really don't. I've been, reading different Facebook groups, posts and things, and they're, even if you were able to get in, you went through all the hoops, you put in your passport photo or whatever other stuff. I haven't even gotten to that stuff yet, so I don't know.
Blood test.
Yeah,
name
whatever
your
you got to do. Yeah. But once you're there, I mean, I've read about these horror stories. Like, people I haven't seen anybody yet say that the amount in their account is wrong. I don't think I've seen that yet. That would be really bad.
Yeah, it'd be bad.
But I have seen a lot of people saying that I know, my performance was X and it says it's Y.
Yeah, but we didn't talk a lot about this, but I as a techie more so on the side, I always thought it's going to screw that up. When you withdrew your money recently, right, it screwed up your PIP. How is redoing the entire system not going to screw up everybody? It shouldn't. They should have figured out a way, but I don't think that's on their priority list. I think they would be like, you know what, you're going to have it from June on.
I read something about that. Like somebody's the annual rate of return doesn't
Maybe
work.
one day they'll catch up and let you go back for old data. Yeah. But I don't think it's a priority.
Yeah, I don't know. Apparently the calculators aren't there either anymore. I mean, that's a really big deal.
Yeah. I don't know. So calculators are interesting too. And this happened in the DOD, I don't know how many years ago, but, because I've been in too long. But there was a time when you could easily use a calculator in DOD once you were logged into the system to figure out your benefits, your pay, your retirement pay, things like that. And because there's a lot of factors, even I think more so in the DOD. Anyway, and they went away magically for years. And then I think they recently came back because a lot of people were like, how am I going to figure out?
Right.
Like, do I stay in longer? Is it worth it? Like all that. And especially if you're like reserve and have active duty, you got all these component things going on. But anyway, the point is, again, doesn't surprise me that they get rid of the things that can tell you information you might want to have to make a decision. Hopefully those things start coming back. We'll see.
Hopefully they do. All right.
Yeah.
So if and when they do, and we do get access to the mutual fund, here's kind of an overview about mutual funds in general. And like most of the stuff I get, it's from Investopedia. There's the link. So mutual funds, can be intimidating for beginning investors. I don't know how intimidating they are, but there is a ton of available funds. There's like 5,000 for us that we have to choose from, and that definitely is going to be a little bit overwhelming to try to sort through. And there's been a couple people commenting on Facebook about how the sorting functionality is really not good. So we'll see how that goes. But the good thing about it is they all have different investment strategies, and you can put together different asset groups. Trading shares in mutual funds are different from trading shares in stocks or ETFs, right? Exchange traded funds. The fees charged for mutual funds can be complicated. We're going to go through a little bit of that. Understanding these fees is important since they have a large impact on the performance of investments in a fund. So going forward, when we're talking about fees, it's only about mutual fund fees. It's not about the $12.95 or whatever per trade that they're going to charge us. It's not the $95 a year for the one fee and the $45 a year or whatever it is for the $55 for the other fee. Going forward in this presentation, all we're talking about is the fees in the mutual funds themselves. Okay. So a mutual fund is an investment company that takes money from a whole bunch of investors and pulls it together into one large pot. Okay, so that is really what a mutual fund is, and it's distinct from an ETF. Okay, so you have a professional manager for the fund that invests the money in different types of assets, can be stocks, bonds, commodities, whatever, real estate. The investor buys, an investor, which would be us, right? We buy a share in the mutual fund. So the share represents an ownership interest in that piece of the fund. So you actually own a piece of the fund. Mutual funds are designed for long-term investors and are not meant to be traded frequently due to their fee structures. Okay?
Yeah, the idea, theoretically, right, is that this mutual fund manager is doing the trading for you.
Yes.
Right? So that's why this was kind of sexy back in the day was, again, when we back up before ETFs, before fractional shares, all this, go backwards. Like your only options were to call a broker and buy a full share of something.
Yep.
Which to some people was not possible, right?
Yeah.
Particularly, retail investors at the lower end.
Sure. I mean, try to buy a share of Berkshire Hathaway for $30,000 or whatever.
So this gave the average person a way to buy into something that was similar, although not the same as like a hedge fund, right? Mm-hmm. I've got a real person that's managing this fund, and I can buy a share of it for a reasonable share price. Right. And so that's the idea, which it is a good idea.
Yeah.
Right. And before you have all what we have, available now, right, we have more options and less fees. Right. That's where I feel like you kind of lose it with mutual funds, unless and I'm sure you're going to get into this. If you do your due diligence and find mutual funds that fit your personal risk tolerance, your your belief system, all of those things. If you find, that's what mutual funds I think were kind of built for, right? Yeah. Is like, okay, this person, but you have no control what's in the fund.
No.
Yeah, and that's why it's meant to not trade, because it's kind of going against the principle of it.
Right. The idea is long-term investment.
You have to buy into whatever their mutual fund principles are, right?
Yeah. If it's a growth, big cap growth. So you're buying, big companies that are growth companies. When the market rolls over as a whole, the fund manager, he's managing a fund that by definition or she is by definition only allowed to buy and sell
small cap.
Whatever. So large cap growth companies.
Right.
If that segment of the market rolls over, that fund is going down.
Yeah, there's no options for them because they're stuck in that little paradigm.
Right.
That's okay, because if you changed it completely, it would not now be a large or small cap fund.
Right.
Yeah. So that's the whole point. Right. And so, and again, now we have the ability to you build your own fund, your own portfolio. You can't build a fund. Well, you could, but you can do that now, where you couldn't do that before.
Yeah. Now there are some really cool sites out there that allow you to do exactly what mutual funds do for zero fees.
Yeah, but you have to be very educated. Let's add that.
Yeah, it definitely helps to know what you're doing.
You have to. Well, you don't have to be educated, but you're going to be pretty risky.
Right.
And that's why we're here. As we're trying to educate everybody.
You can pull individual stocks into a basket, because that's what mutual funds did. They enabled you to not have to buy a share of every individual stock. Mm-hmm. You could look at a mutual fund and say, if it was like a tech mutual fund, you could look at it and look at the components of the fund and say, yep, if I could, I would buy one of all those shares. But I don't have to. I can just buy one share of the fund, and I'm good. And that was great when it was created. It was a great idea. And we're so far past that now.
Yeah.
It is unbelievable that this is our brand new solution, is the mutual fund window.
Yeah. When did mutual funds come out? Was it the mid-'80s? 70s. Yeah. Yeah. So again, doesn't surprise me that the government is still stuck in 1975.
Wow.
It is what it is. At least it's more options. But I think hopefully what you guys that are watching this show, and please share this with your friends and tell them to fast forward to the mutual fund part if you want to. If you're not educating yourself, because if you go around and look to get explanations of mutual funds, I just don't feel like they really give you a real grasp, like what we're trying to do. The idea is, because they'll use, most of the time when you find it, you're going to find like investor language.
Sure.
Right.
100%.
And if you understand investor language, then you get what they're saying, but you wouldn't have to look it up because you already know what a mutual fund is.
Right.
Right. And so the basic idea is you've got this fund manager managing a fund for you. If that fund, that collection, that portfolio matches what you want to invest in, there's no reason to be in and out. Right.
Right.
And so, of course, we as active managers of our money not necessarily in tune with that, right? So
right.
what we would want to do is to be able to bounce from mutual funds that are performing well. The problem is you get killed with fees,
Yep.
right? And so ETFs are a better option for us because there's no fees.
Right.
And so that's where when we're talking about kind of newer versions of this, that's what an ETF generally would be.
Yep.
I can bounce back and forth between ETFs way easier, cheaper,
Right.
more efficiently than I can mutual funds. But if mutual funds are all you got,
That's all you got.
then it's more than the 3 stock funds we have now.
Yes, and we're going to get to a little bit. Well, let's just keep on going.
Jump in.
There's so much stuff.
Jump back in there.
So, mutual funds are often attractive to investors because they are widely diversified, right? Like we said, the fund manager pulls in 10 or 20 different stocks in one sector, so you're kind of diversified within that sector, right? Diversification helps to minimize risk to an individual investment, right? It diversifies it across the number of companies that they have in the fund. So rather than having to research and make an individual decision as to each type of asset to include in a portfolio, mutual funds offer a single comprehensive investment vehicle. Some mutual funds can have thousands of different holdings. Mutual funds are also very liquid, which is a good thing. It's easy to buy and sell them and redeem your shares. But there are some interesting things if you don't already know about mutual funds. There's a wide variety of mutual funds out there. They primarily fall into either stock funds, bond funds, balanced funds, which is just essentially 50-50 or something close thereof of stocks and bonds, and then index funds, which track the S&P 500 index or the Nasdaq index or whatever. They're generally passive. So those are kind of the 4 general buckets of funds. I don't need to read all this. Stock funds make investments in the shares of different companies, right? Stock funds seek to profit. It's not that interesting. Balanced funds hold a mix of both stocks and bonds, like we said. The distribution among stocks and bonds in these funds varies depending on the strategy. Makes sense. It could be a 70-30, balanced fund or a 50-50 fund, whatever. This is one easy way, actually. If you like the Warren Buffett idea of 70-30, you can buy one mutual fund that will keep you, 70% in the S&P 500, let's say, and 30% in a bond fund, and it just sits there. And there's not a whole lot of turnover, so the fees wouldn't be very much. Like it says, right, the fees for different types of funds are lower due to infrequent turnover because it's passive. But if you're going to do that, you would just do it in the TSP because there's 0 fees, basically. Okay. So the mechanics of trading is different from an ETF, okay? Mutual funds require minimum investments of anywhere from $1,000 to $5,000. And it can be higher than 5,000. So for us, we have to have a minimum of $10,000 to invest in the mutual fund window before they even let you begin. So it's very possible that if you want to diversify between mutual funds, if you have to kick in a grand per fund you want to do, then it limits the number of funds you can do. Unlike stocks and ETFs, where minimum investment is 1 share, and that's not even true anymore because now we have fractional trading. You could buy $10 worth of an ETF if you wanted to. Mutual funds trade only once a day after the market closes. That's a big one. You're not getting daily, when we do charts, you're not getting daily candlestick charts. You can get weekly candlestick charts because they trade once a day. So a candle would be the price movement in a week. So you could do, like the 2-year weekly charts that we do. But if you ask the stock charts to give you a daily candlestick chart, it can't do it. So it gives you a line chart. So what that basically, actually this is the part that talks about it. So the price for shares in a mutual fund is determined by the net asset value calculated after the market closes, not unlike our core TSP funds. The net asset value is calculated by dividing the total value of the assets in the portfolio minus liabilities and outstanding shares. So this is different from stocks and ETFs where prices fluctuate second to second during the trading day. Okay. So an investor is buying or redeeming fund shares directly from the fund itself. So because we said a mutual fund is a almost like a trading club. You buy into it and you're buying a piece of the fund. So when you sell, you're not selling what's in the fund. You're selling your piece of the fund to somebody else. So the fund buys it back from you. They're redeeming your mutual fund shares. It's not the same as buying and selling a stock on an index. So this is different from stocks and ETFs, wherein the counterparty to buying or selling of a share is another participant in the market. So that's not what we're doing. Mutual funds charge different fees for buying or redeeming shares. So let's get to the fee part a little bit. It is critical for investors to understand the type of fees and charges associated with buying and redeeming mutual fund shares. These fees vary widely and can have a dramatic impact on the performance of an investment fund. Cannot overstate that enough. Some mutual fund fees charge loads. Okay, they can either be front loaded or back loaded, right? So when buying or redeeming shares in the fund, the load is similar to the commission paid when buying or selling a stock, except we don't pay commissions anymore when buying and selling a stock. The load fees compensates the sale intermediary for the time and expertise in selecting the fund for the investor. That is not the fund That's not the fund manager, right? That's a different person and it's a different fee, and it's not something we'd be paying if we had ETFs. Load fees can be anywhere from 4 to 8% of the amount invested in the fund. Okay. A front-end load is charged when an investor first buys shares in the fund. So let's say you come into the mutual fund window with $10,000. If you buy a front-loaded fund, the charge is 8%. Your $10,000 is reduced by $800 before you even start, right? That's not counting the $12.95 fee to buy it. It's not counting the money, the annual stuff you pay to TSP.
You have to add all these up to see if that's going to and look at the performance of the fund to say, am I going to come out even flat here?
Right.
That's why these are definitely long-term investments. If you're going in negative, which you're going to,
yes, absolutely.
The moment you move your money into a mutual fund, regardless of the percentages, first of all, you have to account for all the fees that are automatically
TSP fees,
right?
Yep.
And so that no matter what, you're starting off negative.
Yep.
And so can you overcome that? And then hopefully, perform even.
I mean, if you have
and then as you pull out,
you're going to get the fees again.
Right.
Yeah. So let's say obviously if you put in $10,000, the relative value of the $12.95 trading fee and the annual fees we pay to TSP and all that. If you're only playing with $10,000, those fees make up a bigger portion than they would if you were putting $100,000 into TSP, right? The fixed fees don't bother me so much. It's the percent fees.
Percentages that get you.
I mean, if you're paying 8% on 10,000, it's $800. That's not great, right? It's 8,000 on 100,000.
Yeah, you're paying $8,000 just to play.
Before you even start. I mean, so to make up 8%, right? You imagine if you're in a fund that isn't very volatile, which most mutual funds aren't volatile like ETFs are.
That's the whole reason for them.
Yeah, but you need to make up 8%. I mean,
first year.
Yeah.
If you're lucky.
Well, I mean, it's only once. You only pay that load once. But it would really incentivize you to hold it.
Well, that's what they're built for, though.
Yeah.
Oy.
Back-end load, also called deferred sales charge, is the charge if the fund shares are sold within a certain time frame. So back-end loads are kind of better because if you hold them for the time period that they want, the percentage of load that you pay goes down over time. So I guess it's better than paying the upfront fee. But I'm not a huge fan of mutual funds. It used to be it was the only option, but now it's just not, and it's frustrating. A level load fee is another annual charge deducted from the assets in a fund to pay for distribution and marketing costs of the fund. These fees are also known as the 12B1 fees. They're a fixed percentage of the fund's average net assets. So this is like overhead for the fund, right? The 12B1 fees are considered part of the expense ratio. So they're not, expense ratio is a separate thing from like the load, right? There's so many fees and they all just add up and they all will affect your overall performance. So the expense ratios include ongoing fees and expenses for the fund, right? It's their overhead. Expense ratios vary widely, generally 0.5 to 1.25%. Passively managed funds, such as index funds, usually have lower expense ratios than actively managed funds. Passive funds have a lower turnover in their holdings. They're not attempting to outperform a benchmark. They just try to duplicate it, just like the C fund. It's not trying to outperform the S&P 500. It's trying to duplicate it. And because it's just trying to duplicate it, you don't need to compensate the fund manager for his expertise in choosing investment assets because he's not doing anything. He's just trying to match what the S&P 500 in the case of our C fund is doing. He's not trying to beat the S&P 500. Okay, so load fees and expense ratios can be a significant drag on investment performance. Funds that charge loads must outperform their benchmark or similar funds to justify the fees. Many studies show that load funds often do not perform better than their no-load counterparts. So there are no-load funds. So I haven't been able to get into the mutual fund window yet, but if I assume that when you get in there, you're going to be able to sort between you're going to be able to sort between load and no-load mutual funds. And if, according to this article, studies are showing that funds that have a load do not perform better, especially taking the fees into consideration, do not perform better than no-load counterparts. So it makes little sense for most investors to buy shares in a fund with loads. Similarly, funds with high expense ratios also tend to perform worse than funds with low expense ratios. Because their high expenses drag down returns, actively managed mutual funds sometimes get a bad rap as a group overall. So this is there's a lot of distinctions in here, right? What we're talking about up here in this part was a load versus a no load. What we're talking about down here is a managed versus a passive, okay? So you can still have loads on a passive fund, right? Why you would select that, I have no idea, but you could. What we're talking about down here is the difference between a person actively managing the fund or the fund being passive, okay? So because their higher expenses drag down returns, actively managed mutual funds sometimes get a bad rap as overall. But this is one example of why it's valuable. In the international market, right, it's too difficult to do direct investments as an individual investor for us, right? They're not very liquid. They're definitely not very investor friendly in some of the emerging market countries. And the biggest one really, there's no comprehensive index to follow. So you really can't do it passively. So in this case, it pays to have a professional fund manager. If you want to be exposed to emerging markets, it pays to have somebody that understands how emerging markets work. So that's just an example of where it makes sense to pay the fee for that if you want to be exposed to those markets. So there's a whole lot more in this article. Honestly, these are just the highlights that I screenshotted. I would definitely check out the link. It gives you a lot more strategies on how to use mutual funds to augment the core TSP funds. But so the bottom line of the article, Benjamin Graham once wrote that making money on investing should depend on the amount of intelligent effort the investor is willing and able to bring to bear on his task of security analysis, right? When it comes to buying mutual fund, investors have to do their homework. In some respects, it's easier than focusing on buying individual securities, which is true, but it does add some important other areas to research before buying. That's the fees. Overall, there are many reasons why investing in mutual funds makes sense, and a little bit of due diligence can make all the difference and provide a measure of comfort. I think I haven't gotten into the mutual fund window, obviously, yet. I'm looking forward to it. I think that the fees make it so that unless you have a very narrow window of something you're trying to accomplish in a mutual fund, it's not. I don't expect it to be worth doing. If
you're actively managing, now if you're passive, it may give you a better option than an L fund.
Yeah. So how do I want to say this? If you could have seen, and you could have, so if you had seen that inflation was going up from the middle of 2021, if you were tracking the bond index and you saw that bonds were turning, if you saw that the conditions were ripe for commodities to start making a big move higher, and commodities have been down for decades,
mm-hmm.
right? If you saw this long-term turn in commodities,
mm-hmm.
and you bought a mutual fund that was a commodities mutual fund, it did really well in 2021 and 2022, and it may continue to do well. At some point, it'll roll over because commodities, they are in cycles like everything else. But if you can find a turn in a major sector that's a cyclical turn, it's going to changing directions for a long time.
Yeah.
Then maybe it's worth hedging your TSP with something like that.
Right.
But you're not going to trade that. You're going to hold it. So I don't want to confuse people. Like, obviously our thing is not buy and hold, but in this particular case, you're going to hold a thing.
Yeah, you hold it for, if you know that, but your probability of a long-term trend is there.
Yeah.
You've done your you've done your research. You're an educated investor. That, of course, that's a good idea.
Yeah.
And I can see, us using the mutual fund window that way.
Yes.
But not as a, 2 move a month or day trading or any of that. No. It's going to be it's not going to be cost effective. You're going to have a horrible return if you count all the fees but I would say, like, if again, it's not passive investing to do what Jerry was just explaining. It's even more active because you have to do a lot of research and you have to be in tune with the larger market, right? Who's looking at commodities that's watching this right now? There's probably a handful, but I would say the majority of the folks are still wrapping their head around, how do I draw a trend line, right? So, and that's not a bad thing, but you can get to a place where that still could be a Saturday afternoon, right? Sunday afternoon, kind of taking a look at the market as a whole. And if you're doing that weekly, like Jerry explained, we have a friend of ours that has done really well in commodities because they were paying attention. Yeah. And so it's hard to see everything, though. That's the problem, right?
We're gonna do some. We'll do some shows about that. I mean,
how to wrap your arms around the larger markets.
Yeah, I mean, I'm trying to whittle through how I'm gonna use the mutual fund window in my TSP, right? Mm-hmm. And there's 5,000 mutual funds or whatever the number is. It's neither here nor there to me. Like right now, for example, value stocks are outperforming growth stocks, right? So they're both going down, but value isn't going down as fast as growth, right? So if you look at that and say, okay, once the bottom does come in, then growth, because it's outperforming while the overall market's going down, it ought to outperform on the upside. Mm-hmm. So maybe you look at that and you pull up a list of value funds that once the S&P itself turns, maybe you buy value funds because you expect that they're going to outperform growth over the long run. Something like that. So, I'm not whittling through 5,000 funds. I'm coming up with like a handful of long-term ideas and then I'll find the funds that fit those long-term things. And then when the market does those changes, then I'll reallocate into those funds.
And just so we go ahead and put a disclaimer out, we've talked about this before. If you are a member of our site, if you're a paid member of our site, do not expect mutual fund alerts.
Absolutely not.
We're not going that direction. There's no way. No. We can't do that. Now, what we are going to do, though, is give you a look into what Jerry's doing in the mutual funds. Yep. And that's, again, going to be another benefit of being a member of our site. You're going to, if you have a desire to learn how to use mutual funds within the TSP, Jerry, go find another, and we're not investment advisors in this capacity, but go find another person willing to use their own money to test it out, to give you the information and education. Right. Go find that, right? I know I'm biased, but
yeah. No, that's what we're doing here.
We're curious because it affects 6 million people.
Yeah. 6
million brothers and sisters of ours in the government and the military. So if there is a way to maximize, to help maximize your TSP account, we're going to figure it out.
We'll figure it out.
Yeah.
All right. So that's about it for mutual funds. Definitely go back and read that article. There's a lot more in there. Bonus chart. The Nasdaq Tech Index from 1999 to present. So this is a chart that I took from the monthly webinar that we did this week to the Facebook group. It's a chart of the Nasdaq Composite Index. So we all know about the dot-com bubble in the late 90s, right? Here's the late 90s. Tech is taken off. It peaks up here in 2000 at 51.32, right? That was the highest share price in 2000, $5,132 a share. By late 2002, the Nasdaq had lost 78% of its value. Okay. It then took 13 years from this low in 2002. It took 13 years just to get back to even. Just to get back to where it was up here at the top in 2000. It wasn't until late in 2016, back in here, that the Nasdaq finally went on to make new highs. So if you had $1 million in your account in 2000, right? You get $1 million in your account back here in 2000. It took 17 years for you to get your $1 million back. 17 years. From the low in 2002, down here, Nasdaq recovers 40% of the losses. So you draw down 78% here, right? From the low here until the top in 07, recovered 40% of its losses. So you're like, all right, you're in here, market bottomed, it's coming back up, it's going to keep going on to new all-time highs, right? No, turns around, gives you a 56% gut punch. So if you're still holding on through all that, it's taken you from 2009 to 2017 to get to new highs. So what if you retired in 2000 with $1 million in your TSP and your plan was to withdraw 4% per year to supplement your pension and make ends meet, right? Because 4%, if you have $1 million in TSP, 4% is 40,000. It's not a whole lot, right? So you're going to add that. It's going to help you make ends meet with your pension. That was based on $1 million up here. You're talking about a 78% drawdown. Your plans are going to change in a hurry. Thankfully, these events don't happen very often, but when they do, obviously they can be financially devastating. And we talk about it all the time, but this is why risk management is the most important thing and why our rule number one is don't lose money. So where are we right now? Can we come up and come down and have a 78% loss? Absolutely, it's possible. I'd have to do out the numbers real quick, and this is a logarithmic chart, but we could come back down and test these highs. We could come back down to 5,000 on the Nasdaq. 5,000 if from 15,000, which is where we were up here. That's 2/3. So from the high, is that an 80% drop from 17,000 to 5,000? Something like that. And you can see from the chart, it's absolutely a possibility. And how long would that take then to get back to the to the high, and what just happened there? So all this only to say that you don't want to be stuck in the stock funds for these big down periods. Okay. TSP fund charts, not too much has changed. We say this all the time. We've been talking about it for months. Until this is the C fund we're looking at. It's a 2.5-year weekly chart. So each one of these ticks is 1 week of price movement. This is the 20-week exponential moving average line. Ever since it got above it back here in COVID, when it tested it, it found support there all the way along until January, when support failed. And ever since then, we've had very, very few pokes up above that 20-week moving average line. So between the 20-week, we need to get back above the 20-week moving average line as a start before price can keep going higher, right? And in conjunction with that, the RSI needs to get back above that 50 line. And it hasn't been there since January when it broke below it. So nothing's really changed on that. We've been talking about the same thing for months. And so if you're only looking at your TSP once a week, you could check in on this on this chart, and as long as it's below that blue line, move on. S fund, same exact thing. S fund peaked really back here in February 2021. We had this little kind of blow off top, but for all intents and purposes, we peaked back here in early 21, went flat, consolidated along that 20-day moving average line, and then in January, once it broke, not January, it was November for the S fund. Once it broke down through it, has never been able to get back above it. And at some point it will. Not anytime soon, it doesn't look like. And we're in the same kind of position with RSI. It's well below that 50 line. I fund, same thing. Had a little bit of a different rollover shape than the S fund did, but it's definitely a frowny face, as JC Pretz likes to say. You want to buy the smiley face and sell the frowny face. And there's nothing too smiley at all about this. So I would not be in the I fund. AGG bond fund, we had a little bit of an uptick here. This is the most interesting thing. I think the AGG is much more interesting than the stock funds right now, because this move is the biggest move ever in bonds. It's a huge move down we've had. And usually when you have these giant moves like that, at some point you're going to get a snapback rally. And so a lot of people were talking about this being the snapback rally. It's not long enough. It's only 3 weeks, and it's not correcting all the way back to.
It's not even close.
Not even close. It didn't even get back. It didn't even come close to getting back up to that 20-week moving average line. So this is a very strong down current that we're in right now. I mean, could it come down and give us a 1, 2, 3, 4, 5? Yeah, it's in the realm of possibility, not probability. More likely than not, this is not going to be the low. But we shall see. All right.
Questions. If you have questions, put them in the comment section wherever you find this video. Facebook, YouTube. Where else do we put it? I need to get a list of things so I can just rattle them off. But anywhere you find it. If you don't have a comment section wherever you find the video, just send us a question to support@growmytsp.com. And the support team will get it off to us. If you have a question that's real personal in nature, we're probably not going to give you investment advice over that. But otherwise, if you have any general questions, happy to answer them. We like the comments. We like the questions.
Yep.
If you guys like it, share it with your friends. If you don't, share it with your friends.
If you want more shorter time frame analysis with way more tools and way more kind of drilling down into the details of the TSP stuff, $25 a month, $250 a year.
Yeah, exactly.
You kind of. Yeah. I was talking to my daughter about it last night, and the amount of money that people, I won't say money people lost. I'll say the drawdown that people have right now in TSP.
Yeah.
I mean, you could subscribe to
A century.
to us for the
For a
rest
century.
of your life.
I think one guy we got a comment recently. It was before this actually. He was like, "Yep, just made enough money to pay for the next 32 years."
Yeah.
Right. All right. Enough patting ourselves on the back. Again, if you missed the make a plan for the bear market, go register for that webinar, and you'll get the video from earlier. All right. See you guys. Hope you guys have a great week. We will see you later.
Next.